Hey guys, what's going on? Coming at you with a Tuesday morning video. Today I want to talk about a stock I haven't talked about in probably years. It's one of my dividend plays. So this is another one that, kind of like Facebook, it hasn't really emerged until recently. I actually started buying Facebook recently, but I haven't talked about this one. So JP Morgan, obviously it's Chase, the bank. Jamie Dimon is the CEO of it. I do like him a lot. I do think he speaks basically how it is, and it's probably the best managed bank in America, at least, maybe if not the world, in my opinion. So this is one of my dividend plays. I don't hold many dividend stocks, but it's getting to a really appealing price kind of. So JP Morgan right now is sitting around 116.38. I do like sub 100, really like 98.75 is kind of where I want to start averaging costs down. It's crazy to think that I was buying this stock at 113, 110, 120 a couple of years ago, and here we are. It's sitting at 116 again. Obviously it's paid me dividends over time, but I technically haven't. I'm right about a break even right now. So I would like to make my position bigger. I haven't bought any stocks in the past week or last week or this week. As I said, it was green Wednesday, green Thursday, green Friday. Had a little bit of pullback today. I'll talk about that later on. Why it was yesterday, Monday. But it wasn't really a big enough pullback from the little rally we had the last 3-4 days last week. So didn't really want to buy anything today. Didn't buy anything last week, so I'm kind of just collecting as much cash as possible to take advantage for my next buy. I would love to buy this at pre-COVID levels, which puts it right around $98. And then if it goes down like to 90, I'll buy more, 85, I'll buy more, 80, I'll buy even more, because long term, obviously JP Morgan will be fine. They have a great balance sheet, great ran company, dividend play. So it's really just kind of, I don't want to say it's a fleet of safety, but when, things get rough, people might default on their loans and stuff like that, but they'll be fine. The banks from stimulus and all the PPE loans and all that stuff, they're flush with so much cash, and their buyers. It's not going to be like 08, 09, or 07 where like banks were defaulting and people weren't paying their mortgages. I mean, the credit to get a house now is way better, and the qualifications they're way more stricter on who they lend money to. So I don't think that will ever happen again personally, and I don't think times will get that tough because our unemployment's very strong still. Whereas in 08, 09 we had very high unemployment and a lot of other issues. So. Also news yesterday, FTX like kind of leaked, kind of whatever, like FTX isn't really talking about it. They did say they want to acquire Robinhood. Be big. I mean, that's obviously the biggest retail trading brokerage. That's really what made the retail people, like that was the preferred platform they used in 2020 and 2021. I think Sam Bankman-Fried, the owner of FTX, sees an opportunity in that. Maybe not right now, but it's very beat down. So in my opinion, what very smart people do is they'll, when stocks are, worst case scenario, really beat down, evaluations are real cheap, nobody thinks they're ever going to turn around. That's really the time you want to buy. You don't want to acquire a company when things are great, because then it's just more expensive to buy. And I think he can do a really good job at intertwining like crypto and stocks and stuff like that, because FTX currently right now is only crypto only. So, and it's a public company, where Robinhood is, FTX is a private company, Robinhood is public. So I think it would be a great buy for him. Consumer staples came out yesterday morning. They came in a little higher than what analysts expected, which is not good. If you're not sure what consumer staples are, it's basically items that last longer than a couple years. So they're not like commodities or like gas, food, energy, anything like that. They're like, consumer goods would be like if you're buying a new set of towels, or if you're buying a new lamp or something like that. So it's not good that it came in high, because to me, and I think what the market thinks is, people still have extra cash to be buying stuff. If things are really tough right now and everyone was running dry money, they wouldn't be buying a lot of consumer staples. They'd be buying essentials. So I think the market didn't like that it was higher than expected. So it maybe predicts or thinks, oh, maybe inflation is going to go a little longer than what I thought and be higher. So that isn't good. I think that's why the market really turned around. Pre-market was green. Then when that news hit, it was kind of red all day. Dow finished down 0.19%. S&P finished down 0.29%. NASDAQ finished down 0.71%. My portfolio got smashed because I hold Voyager. Massive pullback in that stock. Coinbase kind of got sympathy pain. Crypto is just really struggling right now. So I was down 2.1%. So, luckily last week, I was up 10, 12% Wednesday through Friday. So I gave back 2%. So I'm still up 8 to 10% if we compare, basically week over week. So still great. I was just giving some money back, basically. Obviously makes sense. We'll see what tomorrow does. It's kind of like slow. There's not really much going on the next week or two until earnings starts coming out, the bank earnings, and then we have the big tech and all that stuff. CPI comes out in July, and then we have GDP that comes out in July too. So that's exciting. So for the Q1, so I do think it's going to be negative. So that would, in theory, put us in a recession because it's 2 negative quarters of GDP. I've been saying I think we're in a recession for, I don't know, maybe 2 months now at this point, maybe a little longer. So I do think we're in it. I don't think it's anything to panic about. If you're not familiar with how like recessions work and stuff like that in the market is very forward looking. So a lot of times when we actually are truly headline news in the recession, that news is already baked in the market. So don't like panic saying, oh my God, we're going into a recession maybe, or we might go in next quarter or the following quarter. So you kind of just want to be ahead of the curve. Like I think we're in the peak of it right now. We might have a 3-4 quarter recession, so into like 2023, but that's fine. If you're a long-term investor like myself, you should really just dollar cost average on your favorite stocks. In this kind of market, you really want to kind of lean more towards strong balance sheets, a lot of cash in the balance sheet. Just companies that can make it through. Obviously, I do have a lot of small and mid caps in my portfolio. Do not plan on selling them. It's just I'm going to focus more on building my large caps. Because they're really beat down. They're 30, 40, 50% off all-time high. So it's just a good buying opportunity. Obviously, if like my Square or my PayPal or some of my favorite ones, go down a lot, Affirm, I'm just going to buy it because I know in the long term they'll be fine. It's just, it might be rough for, 6 months to a year with those companies. But if you're a long-term investor with a 3, 5, 10-year, 15-year vision in these companies, you're going to look back and say, oh, I'm so glad I was buying when it was down at 52-week lows. Like, whatever, it's not a big deal. So they'll all make it through, in my opinion. They might just not have the best earnings and, growth numbers and all that through hard times. And if unemployment starts going up, then it's going to be worse. So long story short, I'm just kind of holding right now. We'll see what happens this week. If I buy, I'll let you guys know. And until tomorrow, that's all I got, really. Make sure you subscribe. So that's it. Talk to you guys tomorrow. See you. Peace.